Hello everyone, good afternoon and salam sejahtera. Welcome and thank you for being here with us today at this webinar session titled What Really Moves the Price of an Exchange Traded Fund ETF, jointly brought to you by TNG Digital, Bursa Malaysia and Affin Hwang Investment Bank. I'm Yuning from TNG Digital and I'll be your moderator for today. So we know it's a Wednesday and some of you might be having your lunch and joining this webinar together with us. So thank you for making the time to be here with us today. So let me start with a quick question for all of you to ponder upon. Have you ever looked at an ETF price and wonder, wait, why is it moving so differently than the market? Or what actually moved the price of ETF? Same here, I do have the same question as all of you when I first explored ETF. And if you ever felt unsure or confused about how ETF pricing or liquidity works, don't worry, we have got you covered today. In this session, we are going to get into the mechanics of ETF, so there won't be any heavy financial lingo, just clear and simple explanation and practical tips for all of us today so that we can have a better understanding of what is ETF. So we'll talk about what really moves ETF prices, how they stay in sync with the value of their underlying assets, and why liquidity isn't just about volume. It's about what happens behind the scene, like the role of market makers and the creation of redemption process. But before we begin, there is some important information and disclaimer on the screen, so do take a moment to have a look. And now, we are incredibly lucky to have someone who knows this space inside out with us here today, Mr. Lim Chin An, Head of Securities Borrowing and Lending and Equity Derivatives from Affin Hwang Investment Bank. He's not just here to explain the technical stuff, he's here to make sure we all walk away feeling smarter and more knowledgeable about ETF. So let's get this started. Hi Chin An.
Hi Yuning, thank you for the introduction. Thank you for having me here today.
Thank you for being here with us today. So shall we get started with the basics?
Yes, let's go.
Okay, so because a lot of us here, even though we have heard of the term ETF, but it's still not super clear to us what actually it is. So Chin An would like to understand a bit from you. Why should investor consider investing in ETF and what actually is an ETF?
Sure. So an ETF or exchange traded fund, it is an investment tool. So we'll answer the why first, why you should be interested in ETF and how it can perhaps help you meet your investment goals. ETF is an asset class, so there are many asset classes for you to decide or choose from when it comes to investments. We have like equities or shares, bonds or fixed income, property and so on and so forth. So ETFs or exchange traded funds is another asset class that you can consider. And why you want to go for it is because they offer a few benefits. Returns is one of them. Returns of ETFs typically range from 5% all the way up to the teens, 15-18%, and sometimes even more, beyond 20%. They are a cost-effective way for an investor to gain exposure to what we call a basket or collection of stocks. And it provides diversification because when you invest in an ETF, you're not only investing in one share, you are investing in a basket. It could be about 30 stocks if we're looking at the FBM KLCI. It could be as large as 500 stocks if we look at ETFs on the US S&P 500 index. It's beginner friendly in the sense that if you're already familiar trading shares, buying and selling shares on Bursa Malaysia, it is the exact same process. So that's why you as an investor might consider ETFs as an investment class. As to what is an ETF, from the name exchange traded fund, you can probably guess or tell that it is a fund that is traded on exchange. So it is something that investors can buy or sell directly on exchange. And typically for an ETF, there is what we call the underlying basket or underlying instruments. So see here from the diagram, one difference between A, buying stocks, or B, buying an ETF, is that when you buy stocks, you have to buy them one by one or individually. In contrast, if you want to buy a collection of stocks, say 10, 20, or 30 stocks, as opposed to buying all that stocks individually one by one, you can consider buying or trading an exchange traded fund on that particular basket of stocks. So in that way, you're trading one ETF and you're gaining exposure to like the basket of 30 stocks, for example. And cost-wise also, it's meant to be very accessible to retail investors. In Malaysia, on Bursa Malaysia, if you go to their website, there's a list of all the ETFs currently available in Malaysia. Currently, there are about close to 20 of them. And the price of these ETFs, they range from like 1 ringgit something all the way to 5, 10 ringgit. So it's meant to be cheap and accessible in that sense as well. So you compare that to buying a particular share that may be like quite expensive, like 80, 100 ringgit and above. Through an ETF, you can gain access via a cheaper method.
I see. So based on your explanation, right, it also sounds very similar to unit trust to me. So may I know what's the difference between ETF and also a unit trust fund?
Sure. So there are a few differences, as you can see in the table that we're sharing. In the case of unit trust funds, we talk about the goal or the objective. Typically, when you look at unit trust funds, they want to beat a benchmark. So if it's a unit trust fund that invests in equities, for example, in Malaysian equities, typically their benchmark would be the FBM KLCI. So their goal would be to perform better or beat the FBM KLCI. Whereas in the case of an exchange traded fund, again, if we use the same index, the FBM KLCI 30, the goal is to track the performance of the FBM KLCI. And next, we move on to the management style. Unit trust funds are typically what we call actively managed. And what that means is that there is a fund manager that will make buy and sell decisions, buying and selling shares on a regular basis for the unit trust fund, as opposed to ETFs where it's what we call passively managed, where the goal is just to track and replicate the index. Third, we look at fees. In terms of unit trust funds, the initial upfront fees tend to be higher than ETF. So you might be familiar if you have a unit trust agent who approaches you to subscribe or buy into a fund. Typically, when you do that in the first year or first step is when you subscribe, you would have to incur like a sales charge or loading, which can go up to as high as 5%. So that obviously affects your returns right from the start. As opposed to ETFs, they are designed to be cheap, hence the fees are much lower, definitely less than 5%. In terms of how they are priced and how you can trade them, what we touched on earlier is in terms of how you trade them. ETFs, they are listed on an exchange. So for example, in Malaysia, we have ETFs listed on Bursa Malaysia, so you can just buy and sell the ETFs through the exchange, where in contrast, in the case of a unit trust fund, if you want to subscribe or put money into the fund, you need to go through like your unit trust agent who will then help you with the process. When you, conversely, if you want to sell or redeem your unit trust funds units, you again need to go through a sales agent to go through that sales process as well. So that's another difference. And the last two rows, we've touched on that. You can trade ETFs intraday through, in the case of Malaysia, you trade them on Bursa's regular trading hours, 9 a.m. to 5 p.m., and you do that on the exchange. Whereas in the case of unit trust funds, you go through your unit trust agent and everything is handled for you by the unit trust issuer itself.
Okay, thanks for the clear explanation of the difference between unit trust fund and also ETF. So now we know that ETF basically is a basket of investment. So instead of just investing in one share, so take an example, instead of buying one apple, we are actually buying a full basket of fruits which consists of different types of fruit in the basket. So that's basically what ETF is. So Chin An, here comes another beginner question from me, because earlier on in the slide you mentioned that for unit trust funds, the price is actually determined based on the day-end NAV price, the net asset value price, right? While for ETF, it's determined based on the market price. So why is ETF price slightly different from the net asset value, and how does it stay in sync actually?
Right. So now we come to the topic of pricing. For ETFs, there is going to be a price that it will trade at, and typically the goal or the objective is for the market price to trade close to what we call the NAV or net asset value price of the ETF. So in practice, there may be fluctuations or variations between the market price and the NAV price, and this is caused by a few factors. One of them is supply and demand. So for example, if there is a very strong demand for a particular ETF, then naturally that will push the price of the ETF up, which could then result it in going above its NAV value. So in that sense, if you were to buy the ETF at that point in time, you would be overpaying in that sense. And conversely, the reverse could happen, right? If there's a lot of people wanting to sell the particular ETF units, that would then create downward pressure on the market price, which will push it below the NAV. And in order to manage or cater for this, what we call imbalance, there is this party, what we call market makers, which we'll get to in a bit, whereby their role is to come in and ensure that the market price of the ETFs closely track the current NAV of the ETF at any point in time.
I see. So in simple terms, NAV actually is the fair value of the ETF, while for the market price is actually the price of an ETF at that current point.
That's
is
exactly
my
right,
understanding
Jenny.
correct?
That's correct.
Okay.
Yes.
So that will lead me to the next question, right? How is an ETF created in the market?
Right. So if we look at ETFs in the market in general, there will be what we call an ETF manager. So the ETF manager will decide and say, hey, look, I think I want to create an ETF on a particular basket of stocks. So what they will do, they will decide what stocks go into that basket. They bundle it into a fund, and then from there, they create what we call the ETF units. And each unit that an investor buys will represent exposure and ownership into that particular basket of stocks. These ETF units, as we talked about earlier, they get listed on exchange. So in the case of Malaysia, they're all listed on Bursa Malaysia. And then once that's listed, investors can go to Bursa to trade, to buy and sell them. So two examples that we're sharing here. One of it is the FBM KLCI ETF. So this is an ETF that tracks our benchmark index, the top 30 stocks. There's also like a bond fund index ETF that tracks the Malaysian government bonds in Malaysia.
All right. Thanks, Chin An, for the explanation again. So now let's move on to another topic where I believe a lot of beginners will also be curious, or sometimes they may find it confusing as well. It's the word that we always hear in the finance industry, which is called liquidity. So what exactly is liquidity, and in simple terms, what does it mean when we say that something is liquid or not liquid?
Sure, yeah, that's a good question, I think. Now we talk about liquidity. Liquidity essentially means, from the point of an investor or a trader, how easy is it for you to buy or sell a particular asset, not just ETFs. This applies to stocks and shares in general. So what we are sharing here to illustrate as an example, as you can see on your screen, this is what we call the order book for a particular ETF. And in this case, we're using the KLCI ETF. It's called FBM KLCI EA. And on the screen, you see many, many numbers. So don't be intimidated by that. Essentially, what this shows you is if you are interested in this ETF and you want to, for example, want to buy or sell it, you would log in into your trading platform, load up this particular stock or ticker, and this is what you would see in the market. And where liquidity comes in is that if you look at the quantities available for you to buy or sell, this is highlighted number 2 and number 4. You can see what we have here, the bid quantity and the ask quantity. So what's the difference between the two? A bid is what people are wanting to buy at. So if you look at the green box with number 2 on it, you will see there's 200, 102,000, 10,000, and so on. That is the quantities in the market. There are buyers willing to buy those quantities at the specific prices that you see. So that's column number 1. So if you look at the first row, you can see that 200, that means 200 shares or units, and they're willing to buy at 1 ringgit and 65.5 cents. So conversely, on the other side, the sell side, that shows you in the market what price people are selling, willing to sell at, and secondly, what quantities they want to sell. So how this ties in with liquidity is that the greater or the bigger numbers that you see on both the buy side and sell side, that typically translated to greater liquidity. So the more there are people willing to buy and sell, the more liquid or the easier it is for you to trade these ETFs. Because if you compare this to another scenario where, worst case, the whole screen is blank, right? You look up the ETF and you want to buy, you can't even see what the price is and how many you can buy. That's an example of bad liquidity or liquidity that's non-existent. In this case, liquidity is when there's a huge number of buyers and sellers, natural buyers and sellers, creating natural supply and demand in the market, which will facilitate your trading, make it easy for you to buy and sell, and give you confidence when you want to trade a particular ETF. So that's why liquidity is very, very important. One aspect that's related to that as well is what you see at the bottom there, what we call the bid and ask spread. And this is simply the difference in the price between the highest price people are willing to buy and the lowest price people are willing to sell. So naturally, if this gap is very tight or small, that facilitates trading for people to buy and sell as opposed to a really wide gap, right? And the tighter it is, the more trading it facilitates, and that translates to better liquidity as well.
I see. Okay, so just before we proceed, just to recap, so taking the first line as an example, so we can see that there's actually 2 buyers,
yes,
who are willing to purchase 200 of the ETF quantity at the buy price of 1.655. Is our understanding correct?
That is correct. So to add on further to the example, let's say you are a seller, you've already bought this ETF earlier on. Let's say you bought it when the price was 1 ringgit and 50 cents, and now it's gone up, and today you look at the screen and this is the price you want to sell at. If you wanted to sell immediately, right, assuming you have 200 units, what you would do is you would key in a sell order for 200 units at 1 ringgit and 65.5 cents, and then your order will what we call matched, and that's done. That's how you would have sold your units immediately at 1.65 half. Alternatively, if you wanted to get a better price or wanted to sell higher, you could what we call queue in the market, and this is the scenario where you would queue your order at a higher price, perhaps 169 for example, and then that's where you will what we call join the queue. You will see now there's 500 shares at 169. You would join the queue there and wait for your order to be filled, which may or may not be filled depending. So if the prices of the ETF continue to go up, let's say from 165 half, it continues to go up during the day. Let's say it goes all the way up to 169, that's when your order will be filled and you will have managed to sell at a higher price in the market.
I see. And the higher the quantity shown, like the bid quantity and also the ask quantity, it means that the ETF is more liquid.
Yes, that just means there's more people, more buyers and sellers who are trading this ETF. So the bigger the volumes or quantities that you see, that will typically translate to better liquidity for the ETF.
I see. Now that makes a lot of sense to me. So for buying an ETF, it's not just about how an investor can actually buy it. It's also about can an investor buy and sell at a better price.
Exactly, that's right.
So our next question would be, how then is liquidity provided for an ETF?
Right, so when we talk about liquidity, here's where we want to touch on what we call market makers. And again, from the name, when you say market maker, it's the role of a market maker is to what we call make a market. So going back earlier, if you recall our earlier slide, there are people willing to buy and sell, when you saw all the quantities there, the role of the market makers is to facilitate by providing liquidity to investors, so that when an investor wants to trade a particular ETF, they can see that there are prices there for them to trade. So going into the slide that you see, there's of course two angles. If you are an investor, you want to buy the particular ETF. If you go into the market and you see no one is selling, then you won't be able to buy the ETF. So where the market maker comes in is the market maker will quote prices both on the buy and sell side. So the market maker facilitates both buying and selling. And from Bursa's point of view, Bursa has what we call market maker obligations. So for example, Affin Hwang Investment Bank, we are a market maker of exchange traded funds. As part of that, we need to abide by obligations such as posting minimum volumes on the buy and sell side, and our prices need to be within a certain spread. So the role of market makers is to facilitate trading, make it easy for investors to buy and sell the ETF, give them confidence that liquidity is going to be there when investors want to buy and sell. And another role of the market maker, again, relates to what we talked about earlier in terms of the price of the ETF. Market maker ensures that the market price of the ETF is close to the NAV at any particular point in time.
So if I hear you correctly earlier, you mentioned that Affin Hwang Investment Bank is a market maker.
That's right.
So does market maker equals to investment bank?
Yeah, so typically market makers can be investment banks, it can be brokers, and how market makers perform their role in terms of ETFs is they participate in also what we call a creation redemption process. So just very briefly, this creation redemption process involves creating ETF units for the market maker to market make, and the redemption process is the reverse. If a market maker has, let's say for example, too many units, they can then go through this redemption process where they go to the fund manager and say, look, I want to redeem these units. So typically market makers in Malaysia, they tend to be investment banks or brokers.
I see. So if we look back at the earlier slide that you show with the bid and also the ask price, so market makers are part of the people who will enter the bid quantity and the bid price, or the ask quantity and the ask price.
Yes,
is it correct?
That's exactly right, Ini.
I see. And are there any other roles of the market maker in creating an ETF?
Yeah, so these are the main roles, is to provide liquidity for investors to buy and sell, participate in the redemption creation process to facilitate their market making, and of course ensure that the market price of the ETFs is close to the NAV at any particular point in time.
I see. Okay, all right. Thanks so much, Chin An. I think we really learned a lot today about how an ETF works and what's inside them, and now also how they are priced, and even what's going on behind the scenes. Okay, so ladies and gentlemen, we have come to the end of our sharing session, and we will take a few questions that we have received from our audience. So Chin An, we actually received one question from the audience. So they are asking, what are some of the tips that you can share with especially beginners when buying their first ETF?
Sure. So in general, and not just when it comes to ETFs, in general, I would say that if you're an investor, know your risk profile, know your risk tolerance, know what you are investing in. Basically, don't just follow the trend or put your money into something that you are unfamiliar with. So in the case of ETFs, I would say know what the underlying basket or what the ETF invests in. Make sure that it's an asset class that you want exposure to and you are willing to take on the risk. So for example, if it's an ETF on the FBM KLCI 30 stocks, make sure that that is the exposure that you want. You want exposure to the index. Secondly, liquidity, we touched on that. Make sure that there is sufficient liquidity in the market for that particular ETF. so that it's easy for you to trade, easy for you to buy and sell. Thirdly, take a look at the fees as well, how much fees the particular ETF charges, because the fees will affect your annual returns. And finally, of course, if you're ever unsure or ever in doubt, please seek advice from your personal financial advisor or someone who can advise you accordingly.
Okay, thanks, Chin An. I think that's all from the audience. Let me check if there are any more questions. Okay, yep, I think that's all for the questions from the audience. So I think what you shared earlier is a great checklist for investors, especially beginners who are taking their first step into ETF investing. So thanks so much for sharing with us today. So, and just like that, ladies and gentlemen, we have reached the end of our session. Thank you so much, Chin An, once again for sharing your knowledge on ETF. And thank you so much, everyone, for spending your lunch break with us today. I hope you found this session very insightful and eye-opening as I did. So we know now that ETF can feel a little technical at first, all those terms like NAV, liquidity, underlying assets, but we hope that today's session helped you simplify what's behind the scene of the ETF, so you can approach investing with a little more confidence. So last but not least, thank you once again to our speaker, Chin An, from Affin Hwang Investment Bank, for patiently breaking things down for us so that we can understand ETF a bit better. So before we go, just a quick reminder, if you are ready to explore ETF yourself, check out the E-Trade feature in your Touch and Go e-wallet, jointly brought to you by TNG Digital, Affin Hwang Investment Bank and Bursa Malaysia, which is designed to make stock and ETF investing more accessible for every Malaysian. So you will also receive a replay link with follow-up resources via email so that you can revisit today's webinar session. So that's all from us today. Thank you once again, and until the next time, happy learning and happy investing. Thank you. Bye-bye.